joining our web. Thank you for joining our webinar this morning. I'm Paloma Sparks. I'm Executive Vice President and General Counsel for OBI. We're here today to talk about HR 1, also known as the One Big Beautiful Bill Act. There's been a lot of coverage about various tax changes. We're going to talk today a little bit more about the things that impact HR and your operations and interactions with your employees. Um, there will be another webinar where we will talk about the tax, more specifically about various tax provisions. That'll be on October 30th. Today we're covering health savings accounts, flexible spending accounts, and various other fringe benefits. To help us understand all of this, we're fortunate today to have Iris Tilley with us. Iris is an attorney specializing in employment law and ERISA, and she's a partner at Barran Liebman. Few housekeeping items before we get started. We've scheduled for an hour, but we may not need all that time. We've also set aside quite a bit of time so we can answer questions that might come up. Feel free to ask questions at any time using the Q&A function. We'll also be monitoring that as we go up through the webinar. This webinar will be recorded and will be posted to OBI's website for folks that couldn't make it today, or if you want to go back and review items. Iris will also make her slides available. And at this point, I'm going to turn it over to Iris.
Thanks so much, Paloma. All right, I'm going to go ahead and start a screen share on this end so you can see my slides. Thanks so much for joining all this morning. All right, there we go. So you should all be seeing my slides at this time. If you have any issues, if you can't view them or anything like that, please throw something in the chat so we know that something has gone awry. But I'm seeing the green box on this side of things, which indicates to me that we're screen sharing and we're good to go. As Paloma mentioned, I'm going to be talking about the employee benefit implications of the new law. And do feel free to pop questions into the chat. I have to admit that I'm not super good at monitoring the chat while I'm speaking. And so if I don't get to a question, I'll send an email out at the end that summarizes sort of answers to any of the questions that appeared in the chat that maybe I didn't get a chance to respond to. So just know that even if I didn't get to something, it would be my own technical failure, and that you will still be getting an answer, but you can always feel free to reach out to me directly as well. And like I said, we'll be talking really mostly about the new tax law, OBA, or the One Big Beautiful Bill Act, or OBBBA, which is a mouthful. I've been calling it OBA. I think different people are calling it different things. And so in the second presentation you may hear other language around it, but I've been calling it OBA just because I find that rolls off the tongue just a little bit easier. And then I added a slide just this morning on just one update on the Secure Act, which is a totally separate law, but we had a big development on it recently. So just, little employee benefits breadcrumb coming your way. All right, so to get us started, I've broken up our presentation into really the topics on the employment or employee benefit side that are covered under OBA. And so we're going to start by talking about fringe benefits. And so for those of you who are hiring employees from different parts of the country, you may recall that before the Tax Cuts and Jobs Act, we were able to take a deduction on the employer expense side or provide tax-free reimbursement for many employees' moving expenses. And that was done through sort of an accountable plan process where the employee would provide receipts and then you could provide a tax-free reimbursement. So the Tax Cuts and Jobs Act, which was in 2017, that eliminated that deduction opportunity and that pre-tax reimbursement opportunity for a period of 2018 to 2025. We were expecting it to come back in 2026. However, under OBA, that exclusion no longer exists. And so what that means is, with the exception of active duty military members and then also some US intelligence employees, so I would imagine people that no one on this call is employing, with the exception of those particular groups, anyone who relocates, regardless of the difference, doesn't get any type of tax benefit associated with that relocation. And so what that means on the employer side is you can certainly still reimburse for the costs of moving expenses. You can still collect expenses, or you could provide a sign-on bonus to help cover those expenses. The difference is just that now you can't do it on a tax-free basis. And so because of that, many employers that we're seeing are starting to just create a moving expense deduction for that. Or not, I'm sorry, not a moving expense deduction, but just a signing bonus. Because really, there's not a whole lot of value in having someone account for and provide receipts. You can just say, hey, I'm going to give you this bonus as a sign-on bonus, use it to move. Because there's just no tax deduction, no deduction on the employee side. That has now been permanently eliminated. Similarly, the exclusion for the qualified bicycle commuting reimbursement has been permanently eliminated. This one is a much smaller dollar amount item, so I've been hearing about it a lot less. But again, the Tax Cuts and Jobs Act had temporarily eliminated this $20 per month tax-free bicycle commuting reimbursement, and now that is a permanent elimination. And so again, you can choose to provide the funds to employees as just taxable at this point in time. Charitable match programs, I think that this is something that will probably be covered in quite a bit more detail in the tax provision of this program that's coming up. But we just have some new floors and caps on the corporate and individual charitable deduction side. So if you do have a corporate match program, I just suggest talking to your tax professionals and making sure that the way that it's designed is still most advantageous under these rules, because it may make sense to make some minor tweaks here and there to ensure that it aligns with the new rules and that you're getting the tax benefit that you as an employer thought you were getting by offering the program. Employer provided childcare. This is one we don't see a ton of this in Oregon, but in other markets, there's more of this, just because I think in some other markets, there are more larger businesses, but there's an increase into the deduction that's allowed to employers if they do provide on-site childcare. So effective in 2026, those numbers go up. So if you are an employer that provides on-site childcare, just knowing that those deduction limits are going to increase next year. And again, that's something that your tax purveyor can certainly provide more information on, or I'm happy to answer questions if there are any that come up. The student loan payment exclusion is one that I see quite a bit in my practice. And so employers have been, and was already put into place, have been permitted to pay up to $5,250 in student loan payments as an employee benefit and on a tax-free basis. And just to clarify, this is different than the Secure Act rule that allows employers to amend their retirement plans to provide matching contributions based on student loan payments. And so that's a totally separate rule. An employer could have this benefit, and then they could also employ the Secure Act benefit. But because they both relate to student loan payments, I often see them get confused, and there's sometimes an understanding that you have to pick between the two of them, but they're actually entirely different. This particular benefit was set to expire in 2026, and it's been made permanent. And so this will be a benefit that can be offered on an ongoing basis. One piece to note on this is I do have a few clients who rolled this benefit out with the understanding that it was going to naturally sunset in 2026. And so their policies were drafted in such a way as to say, okay, this is in place for this period of time. And so I would certainly suggest that if you do currently have this policy in place and you don't want to continue it, make sure to affirmatively communicate to employees that it won't be continued. Because even if it was initially drafted in a way that said, hey, it applies for these particular tax years, employees will forget that. And so I would certainly suggest, if you're not going to continue it, or if you had communicated it was only going to be through the end of this tax year, and you are going to continue it, just affirmatively communicating that to employees just so they aren't surprised in the next year. And then also you're getting credit for offering the benefit if it will continue. But again, this has no relationship to the option that employers now have to match student loan payments in the retirement plan. That's a totally separate rule. And if you have questions about that, let me know. I didn't go into it here just because it's not part of OBA, it's part of a separate law. So the decap limit increase is another one from OBA. And this one I was personally excited about, not even because I still have kids in daycare, but because I remember when I got my first daycare bill, as a lot of people do, being so shocked that the limit was only $5,000. And the decap limit relates to plans that employers can choose to have in place that allow employees to defer tax-free funds and then get reimbursements for amounts spent on daycare, camps. There's a whole list of items that are permitted. And that number has been set at $5,000 for, I think since inception of the law. And unlike a lot of other limits you see in a 125 plan and a 401k plan, these are not limits that are indexed to increase each year at the IRS's discretion. They're just flat amounts set in the statute. And so for the first time in, I don't know, my memory, the limit was increased to $7,500 for a couple or $3,750 for married individuals filing separately. And it still is a set number within the statute. So we're not going to see it indexed up, but it is a little bump up. And so I do suggest that if you do offer a dependent care flexible spending account, or they're also called dependent care account plans, which is where the decap comes from, make sure that those numbers are updated within your documents. And honestly, even more importantly, within the forms that employees complete, because you don't have to allow the full 7,500, but if you wish to allow the full 7,500, your forms are just going to need to be updated to actually reflect that particular amount. I do have a couple of clients who are opting not to, just because they don't want, the potential liability of someone opting in the higher amount. However, I would say that most clients are opting in for that 7,500 because it really does only cover such a fraction of childcare expenses if they do have employees who are in full-time daycare. Just as one more quick reminder on the decap side, some of you may have experienced this, but the dependent care account plans have stricter non-discrimination rules than a lot of other plans. And so especially with this higher limit, I would definitely suggest considering having your plan tested by the company that runs it partway through the year. And then that way, if we do have to pull down contributions for some of the higher cost people, there's plenty of time to take care of that. Because what we'll sometimes see is if the higher comped people are deferring more, if the workforce that has younger kids just also happen to be your more highly compensated employees, then a lot of times there's higher utilization at that level. And because of that, those numbers will sometimes have to be pulled down. That's certainly something that we've run into at our firm, is that just a lot of our support staff are, their kids are older, they're not still utilizing this type of benefit, but some of the younger attorneys are. And so we've run into some testing issues that we've had to correct partway through the year. So just a few payroll considerations. A lot of these have been in the news quite a bit. So I would imagine that many of you are already very familiar with these particular considerations, but I'm just going to take a second and kind of touch on some of the highlights here. So no tax on tips has obviously been getting, I would say, more news coverage than almost anything else in this bill. Potentially tied with no tax on overtime, which I'm talking about on the next slide. However, both of those provisions are really kind of, I think, where the news bites have been. And so as a reminder, you may already know about this, but this is an individual deduction. So you as an employer are not required to not tax tips, and in fact are required to continue to tax tips as you have been taxing them. And so for an individual on their W-2, they're still going to get taxed on that full amount. It's going to include the tip income. However, the distinction is that there will ultimately be some type of carve out that the employer is going to need to report tips separately. We just don't yet have all the details around this. And so based on the guidance that we've seen so far, we're expecting that the employer may not have additional reporting requirements for the 2025 tax year, which they'll be, providing the provisions for it or the W-2s for in 2026. But going forward into 2026, we might see some different rules about how the withholdings are reported. I'm imagining that we might see a specific box on the W-2 that any tip amounts are reported in. And so just knowing that there's probably going to be some adjustments, we just haven't yet received guidance on that. However, there probably will be some guidance that ultimately comes out that at least says, how W-2s are going to need to, reflect tips or reflect some estimation of tips this particular upcoming tax year. So we're keeping an eye on this, certainly. However, the actual deduction is going to be on the employee side, and it's going to be up to the employee to ultimately confirm that they fall into one of those categories of employment that the IRS is recognizing, because they're really looking at categories of employment where tipping is traditional. And so I would imagine that there are a category like a restaurant worker is going to be very obviously within that category. I'll be curious whether they include, for example, a tour guide. I think is a little bit more vague. People traditionally do tip, a tour guide or someone, with that type of role, but it's not necessarily part of the social mandate in the same way that a restaurant worker is for tipping. And so it will be interesting to see how that list is ultimately defined. However, we'll be receiving a lot more guidance on this. It's currently set to expire on 12/31/28, so for a pretty limited period of time. However, as we saw with those exclusions for moving expenses and the bicycle commuting expense, it could certainly be made permanent, or it could also be extended for a period of time. And I have a little bit of information here about the deduction cap and the gross income. Those numbers are indexed, and so those will change from year to year. But really, those are going to be pieces that are largely individual concerns. Those aren't going to be pieces that the employer really has to worry about in their reporting, other than, they may make the decision whether or not to follow new W-2 guidelines if they're not sure whether or not someone actually qualifies. So very similarly, no tax on overtime. Again, this is ultimately going to be an employee issue to take that deduction when they file their own taxes. On the employer side, what I'm imagining is that we are going to see, again, W-2 changes that will provide that overtime is potentially reflected separately, as opposed to being reflected as part of sort of that overall lump, just to make the accounting on it easier. But we're still waiting for a lot of guidance on that. FLCLA overtime is the only overtime that's included in this. And that's important for any employers who do have union employees, because a lot of times a collective bargaining agreement will provide for overtime during situations that the Fair Labor Standards Act doesn't. And so if you do have a collective bargaining agreement or other policies, for example, some medical offices will provide that if an individual has to work on a holiday, that they are eligible for overtime. And in those situations, the no tax wouldn't apply. And so once that reporting does go into effect, just making sure that only that overtime that actually falls under the FLSA, and it's really only the 0.5, not the full 1.5, is being reported. But we're going to be getting a lot more guidance on this. But I just make those notes just if employees ask those questions, if they say, hey, you pay time and a half if I work on Christmas, you can say, well, no, not unless you actually, are working over 40 hours. And so the FLSA overtime would apply there. Individuals won't be required to itemize. Again, that's really an individual issue. However, I do think that it's relevant just because most people don't itemize when they do their taxes. And so it is effective for this tax year, and it has the same expiration of 12/31/28, which again could be made permanent, could be extended, or it could just expire on that date. And we're expecting to see, again, some W-2 changes roll out for 2026 for those W-2s that you'll be publishing in 2027. So moving into some grab bag items, we do have some changes within OBA on the ACA premium tax credits. And these are for small employers and individuals who enroll in the exchanges. And so there are now exclusions, and I think that this certainly aligns with what we're seeing from this administration in terms of immigration policies, is that individuals who are lawfully present but aren't citizens have now been excluded. So they can no longer take the tax credit that would have otherwise been available to them based on income and based on enrolling in the exchanges. Again, this is really mostly an individual issue. However, some smaller employers do operate what's called an ICARA or ICHRA. I never know how to say it, but ultimately these smaller employers are permitted to pay for individual coverage through this HRA program. And so for those individuals, they may have people, or those companies, they may have people who are affected by this, but just knowing that that on the individual tax side, this could be a change in the cost of coverage for some employees. The SALT cap deduction is something that I would imagine is probably going to be covered in quite a bit more detail in the other more tax specific presentation. However, I wanted to note it here just because it is something that comes up quite a bit, especially with higher earners. And so the SALT cap had been taxed at 10,000, and we have a retroactive increase that brings it up to 40,000 with some income limits that it phases out on. And so in 2030, it goes back to 10,000. And so this will just be something that, is of relevance, I think, to a lot of business leaders. So I note it here, even though it's not truly an employee benefits issue. The paid family medical leave credit is something that I would say that a handful of employers are starting to implement. And so what it does is it increases the business credit available to companies that do offer paid family leave. And this would be different from the family leave that's provided by the state. And so just knowing if the state is paying for that leave, you certainly wouldn't be able to also get the credit because you're not making the payment. However, it's an extension of a law that was set to expire in 2026. It makes it permanent, and this increases the amount from 12.5% to 25%, and then it takes effect in 2026. And so if you're curious kind of how that could work for your organization, certainly reach out. I've seen less utilization of it in Oregon and Washington just because there's already so much paid leave available, but some employers are certainly able to utilize it, which can be a great benefit if you're already offering that paid leave to your employees. I think that this is personally my favorite change within this law. So health savings accounts, we've been in a really messy situation until recently, specifically with telehealth services. So as a reminder, health savings accounts, and I'm realizing I probably should have spelled it out on this slide, but they are accounts much like a flexible spending account that an employee might have to pay for things that their insurance doesn't cover. But these health savings accounts are a little bit different for those who aren't familiar. They carry over from year to year. Some individuals will use them to kind of stock money away because they could even use them in post-retirement years. However, an individual can only participate in a health savings account if they're part of a high deductible health plan. And every year, the IRS sets the limits for what the parameters are in order to qualify as a high deductible health plan. So with that kind of background is during the COVID years, telehealth services were excluded from the type of care that would preclude somebody from having a health savings account. So as a general rule, with the exception of preventative care and a few other minor items, coverage cannot be offered to an individual on a high deductible health plan until they meet their deductible. And so they get to take advantage of the network that the plan is part of, but ultimately they're paying for everything until they hit that deductible amount, with the exception of preventative care and a few other little items that aren't deductible covered under the Affordable Care Act. And telehealth was also carved out and treated like preventative care during the COVID years, with the reasoning being people really couldn't go into the doctor. It was difficult to get care. So it was carved out on a temporary basis. And we kind of, on the benefit side, always thought that that was going to be extended. And there were a bunch of proposed bills that did extend it, but then ultimately it wasn't extended. So then all the vendors who were offering this telehealth services started kind of trying to repackage their services as employee assistant programs or something else that wouldn't cause someone on a high deductible health plan to lose their HSA eligibility. And I should note here that we're just seeing, because premiums have been increasing so much, just almost every employer at this point offers some kind of health savings account, and we're just seeing a lot more utilization. I mean, some employers are offering only health savings account eligible plans. So this telehealth services issue was becoming kind of a big issue because everyone wanted access to telehealth services, but they were creating all these issues under the high deductible health plans. So I was really relieved to see that effective immediately, these pre-deductible telehealth services are allowed. And so we've seen a rollout already of a lot of telehealth services under high deductible health plans. And then those health plans that were sort of trying to package their telehealth services as an employee assistance program or something really, really minor are now able to expand out those programs. And so I'm expecting to see even more rollout of that as we go through open enrollment and into next year, because the telehealth services can often be offered at just a very cost competitive place. And so they can be a good cost savings from the employer perspective. Another change on the health savings account side is concierge arrangements. And for those of you who are not familiar with concierge arrangements, those are arrangements in which an individual will pay a doctor a monthly fee in order to access them effectively for primary care needs. Any type of specialist needs are always referred out, and those are generally run through the health plan. But the concierge needs are paid specifically by an individual employee, and they've been paying them on a post-tax basis. However, starting in 2026, they can be run through a health savings account on a pre-tax basis. I have to say that a lot of people were already running them through health savings accounts. There was already an argument under the code that that was permitted, but it wasn't explicitly allowed. And so for those people who do utilize concierge arrangements, this is certainly a welcome development. So what does this mean on the state tax law side? So we have at this point 42 states. So the majority of states have individual income taxes. Washington is obviously an exception to that. Oregon is not, as I'm sure all of you know. But the states will generally conform with the Internal Revenue Code in really one of three ways. And so some states do what's called rolling conformity. And so what that means is that as the Internal Revenue Code changes, that state's tax code will change as well to align to it. Then some of them will say, we align as of a specific date and time. So they'll say, we aligned as of January 1st, 2023. And then any changes that took place after that, the state will decide whether or not they want to adopt. And then there's selective conformity, which means that they roll with the tax code, but as you probably guessed from hearing the language, in selective features. So historically, Oregon has been a rolling conformity state. We have recently seen some specific areas being called out and separated from the federal tax code. So there are some differences at this point in time between Oregon and the federal tax code. For purposes of these particular rules, there haven't been any carve-outs yet, but that's certainly something that we'll be watching. I don't anticipate that Oregon would treat no tax on tips or the overtime rules differently than federal law, but we may see carve-outs in other places. It'll just be something that we'll all be keeping an eye on. But at this point, everything within this law will operate the same way in Oregon. The Iris just this morning, and so this was like I threw this in at the last minute because it just came out this morning, but the Iris did increase or released some of its 2026 plan limits. So specifically for Section 125 plans, so that would include like a flexible spending account and a health savings account, transportation plans, and then adoption assistance plans. We have the limits for those. We're still waiting on limits for a bunch of other stuff. But if you do want the link to those, just let me know and I can send it over to you. I just didn't cover it here because it was literally released like 30 minutes before I was presenting. And then the last thing I was going to cover today is the Secure 2.0 reminder. And this was what I mentioned early on, is that this doesn't actually relate to OBA at all. However, it's a big deal in the retirement plan space just because it creates quite the administrative hassle. And so I just wanted to take a minute to talk about it since we're talking about employee benefits and we're talking about tax. And so, as a reminder, Secure 2.0 was one of three laws that was released in the last couple of years that relate specifically to retirement plans. There's Secure, obviously, which would be Secure 1.0, and then the CARES Act, and then Secure 2.0. And what Secure 2.0 did on the Roth's catch-up contribution side is ultimately for the purpose of tax. I mean, effectively, they were trying to balance it out from a budget perspective. So they provided that any employee who earns over 145,000 in the prior tax year, and this is an indexed amount, and so we'll see this amount tick up over time, has to make any catch-up contributions in that subsequent tax year on a Roth basis. So that means on a post-tax basis. And the idea is then for these higher earning employees, they're not able to defer as much of the taxation because they can make all of their regular elective deferrals on a pre-tax basis. But once they hit that Roth, the catch-up point, then at that point, everything has to be on a post-tax basis. And then the government gets the taxes earlier, so they're able to better balance, other sort of tax benefits within the law is the background on it. And so initially, this was supposed to go into effect as of 1/1/25. The IRS put out non-enforcement guidance that stated that they wouldn't enforce it until 1/1/26. And we were all really hoping that the IRS was going to push it out a little bit further. And the reason for that is it is just a big administrative task. Is that payroll needs to be informed about, everyone who hits this limit in the prior year. Payroll is going to have to figure out, how to then switch over and make these contributions raw. There's a ton of accounting that's going to happen in the background. And basically no one ever wants to do it. Is kind of the background. And so we were all hoping we'd maybe get another year, maybe it would just die out and never happen, kind of like much like the Cadillac tax with the Affordable Care Act. However, we did get regulations on September 15th, my husband's birthday. And those regulations do state that it's going to be moving forward. The actual regulatory language within those regulations does not take effect until 6 months into next year. And so there is a period of time where we're kind of on a good faith enforcement standpoint. And so it's not that the specifics within those regulations take effect. However, the reality is that those regulations are honestly, in large part, helpful in figuring out exactly how to administer this. And so I wanted to flag this just because a plan amendment will be required before the end of the year. And then there's just a lot of administrative setup. And so if you do sponsor a 401k plan, you probably, really any type of retirement plan that allows catch-up contributions, you probably have already been talking to your vendors about this. However, just to highlight a couple of points around this. Again, it will take effect 1/1/26, but it's based on income from the sponsoring employer in the prior year. So if you have someone who was hired halfway through 2025, and while they would normally make over 145,000, they only made 65,000 in, I think that's a work math wise, let's say 80,000 in 2025, you wouldn't have to worry about them for purposes of this rule for the 2026 calendar year. So you're always looking back at calendar year income in the year prior. And so that does make it a little bit easier to administer. However, there are also some weird regulatory rules around kind of what to do if an individual opts to do Roth catch up for their elective deferrals. And the rules provide, okay, well, if they do that, then they can actually make a choice and not have Roth on their catch up. So there's quite a bit in the background that's just going to make this difficult to administer. And so it's just important to make sure that you're talking to your vendors early. And just to flag this question, because I think that this is the number one question I get about this particular provision, is that unfortunately, The IRS explicitly prohibited making Roth the only option for catch-ups. And so we were initially hoping we could just provide that anyone who makes a catch-up contribution, and so that's a contribution beyond the elective deferrals because that person is nearing retirement age, we could just make those all post-tax. And the law specifically said, or the regulations specifically say, no, no, you can't do that. It has to be specifically for these employees who qualify because they meet this particular income limit. And so because of that, that just creates more administration. So just ensuring that you're talking to your vendors. If you do have questions about this, please don't hesitate to reach out. I think that it's a funky one and it's just requiring a lot of administrative work on the back end from what I'm seeing from my clients. And so that's everything that I have for today. If you do have any questions, please feel free to reach out. I can also hang out and just see if anyone does have any questions that they want to pose right now and could answer those as well. Looks like maybe nothing for the moment. Yeah, I'm sorry. Go ahead, Paloma.
I was just gonna just to put it out there. So, um, when we were talking about moving expenses, and sign-on bonuses, it did bring to mind are there pay equity issues with that?
So signing bonuses are included within compensation for pay equity purposes. Depending on the person's individual role, if they are a person that fulfills a unique set of duties, for example, if you're bringing over a CEO, then there really isn't anyone else within their pay equity class. But yes, you're absolutely right. If you're hiring an accountant from New York and you employ 7 other accountants, there would need to be a legitimate pay equity reason that that person was getting the bonus when others weren't, which, yeah, I mean, does obviously make it more difficult.
Hey, I don't see any other questions. Um, hang out for a few minutes, see if anybody has any
Yep.
questions, or maybe we'll just end earlier.
I always worry when I end that quickly that I was talking really fast. But the last time I talked about this, it was in a room where people were, more kind of we were all just chatting, and so then it's easy to go the hour. But no, certainly. I mean, if you have questions that come up later, let us know. I feel like there has been a lot of news on this, so there are also just maybe fewer questions at this point.
Oh, um, there was a question about when we'd be sending out the follow-up email. We don't usually send it in an email. It'll be posted on our website, just under events, and you can scroll through and see the webinars, and it'll have the materials and the link posted there. All right. Well, thank you so much, Iris. This has been really helpful. And as soon as we're able to get to it, we'll have materials posted on the OBI website. Remember that there will be another webinar on October 30th, that'll talk a little bit more in depth on some of the other tax provisions of OBA, HR1, whatever.
HR1 is probably a more natural way to say it than OBA.
All right. Well,
Thank
everyone,
you so much, everyone. Have a great day.
have a great day. Thanks.